Whether you're new to investing or not, the Roth IRA is one of, if not the most powerful investment account that many investors overlook, and if used properly, the majority of you watching could literally have hundreds of thousands of dollars more in your pocket down the road. Now, before I explain the biggest downsides of other investment accounts, why the Roth IRA wins my vote, and how to maximize the opportunity, to quickly sum up what a Roth IRA is, the term IRA stands for an individual retirement account, which means you have complete control over this account and the investments you choose. And then the term Roth pretty much reflects the tax structure of the account, where the amount you contribute has to be taxed in the year up front, but as you invest throughout the years, you get to avoid taxes completely, with the biggest benefit being once you pass the eligible age of 59 and a half, everything in the account is completely tax-free, assuming it's been 5 years since you first contributed into the account. But knowing that, my name is Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's first analyze the biggest downsides of other investment accounts when compared to the Roth IRA. To start this off, understand that all the accounts I'm about to show you are extremely beneficial to use if you manage them properly. I'm just simply pointing out the downsides that impact the reasons on why I say the Roth IRA is my favorite overall. And so the first accounts to look at here are employer-sponsored retirement accounts like the 401k or 403b that have additional benefits like the ability to have an employer contribution match. But a downside of most employer-sponsored retirement accounts compared to Roth IRAs is that they have limited investment options, where generally you cannot buy certain investments like individual stocks or bonds. Not to mention, but depending on your employer, the investments they offer may also have high fees that are unnecessary and can seriously cost you a ton of money over time. On top of that, there are likely to be other fees that you don't know about, where something like a 401k plan, you could be charged due to areas like record keeping, accounting, legal, and trustee services. And the last point I'll mention here that I've heard from others I personally know is when it comes to vesting rules. As I mentioned, a benefit to employer-sponsored accounts is that they may offer a contribution match, and a simple example is like saying you contribute 3% of your paycheck into your 401k, and your company says that they will match that 3% every paycheck. But something to be aware of here is that if you invest in your 401k today and quit tomorrow, you can't lose the money that you put into your 401k as the employee, but to attain the full ownership over your employer's matched contributions, you may need to work for the employer for a certain number of years. And if you leave a position voluntarily or otherwise before the required period has elapsed, you may not receive all or any of your matched funds, and of course the plans are all different with their requirements. But aside from employer-sponsored accounts, looking at traditional brokerage accounts, one of the biggest downsides here when compared to a Roth IRA is the impact of tax drag on your portfolio over time. The biggest causes of tax drag come from high turnover mutual funds that can trigger taxes to you unintentionally, or an even more common one is from dividends. You see, when it comes to dividend investments, whether you reinvest the dividends or not, they're going to trigger taxes to you that are going to force you to have a tax bill at the end of the year. To reduce this impact, you would ideally want to invest into more growth-oriented stocks that pay low dividends. But whether we look at the high fees from employer-sponsored accounts or a high tax drag in a brokerage account, having $500,000 invested over 20 years with a 1 to 2% drag, you could easily be missing out on hundreds of thousands of dollars. Besides that, another downside of a brokerage account when compared to a Roth IRA is the impulsive risk of making emotional trades or knowing you could take the cash out at any time, which could lead to wrong financial decisions that lower the odds of building true wealth. Aside from that, another account that I also love and recommend if you are eligible to use it is a health savings account, an HSA, where some of the plans allow you to invest and manage everything on your own. You can use the money at any time you want for qualified medical expenses, and they are a triple tax advantaged account, giving you tax benefits when you contribute, invest, and withdraw. But the downsides compared to the Roth IRA is that to avoid taxes and fees, the HSA is solely meant for qualified medical expenses, and that is at least until you are at the age of 65, where you can use the funds for non-medical purchases, but the withdrawals for that are going to have to be triggered as ordinary income. And the last account I'll mention is if you were using a traditional IRA instead, where the biggest downsides here include the fact that they have RMDs, which are required minimum distributions. This means that you are required to take out a certain amount every year once you reach the age of 73, and then the other downside is the fact that after all the years of growth when you are using a traditional IRA, you're going to have to pay tax on the back end when you withdraw. Now don't get me wrong, there are times when a traditional IRA may actually make more sense than a Roth IRA depending on your age and personal situation, where for example, if you are in the late to early 40s and above and you have a higher income than you expect to have in retirement, you may be better off using a traditional IRA and getting a tax deduction up front, but I would highly recommend looking into that further and talking to a financial expert. But especially for most that are younger than that, I highly recommend the Roth because if you have time to compound your investments, the ability to avoid taxes after all the years of growth would be much more beneficial. Needless to say, each of these accounts have great benefits if you use them properly, but let me now go over exactly why the Roth IRA currently wins as my favorite overall choice. To clarify, no investment account is perfect. For example, the downsides of a Roth IRA compared to a traditional brokerage account is that you still have to wait until 59 and a half to use the earnings completely tax-free and penalty-free. But I will say for those hesitant on starting, if you are in the absolute need, because the contributions that you put into a Roth IRA are taxed up front in the given year, the account allows you to withdraw what you contribute at any time, tax and penalty free. You see, the Roth IRA has an annual amount that you can contribute into the account every year, and for the year of 2025, that amount is $7,000, and then an additional $1,000 if you are 50 or above. You can contribute as much as you want or can afford. You do not have to reach the minimum, but the reason I really like this is because it feels achievable for many that prioritize it, and if done properly, the long-term benefits can really help lead to a successful retirement. But a quick note I'll also add on that as well is that there are income limits with a Roth IRA, where for example, if you are single and make over $165,000 per year, then you are not allowed to directly contribute into your Roth IRA. But there is a way around that by doing what's called a backdoor Roth IRA, but I'll save that for another video. And on top of that, unlike the traditional IRA where you have to take a required minimum distribution starting at age 73, with the Roth, this does not exist and you have the complete control and flexibility to withdraw however you want. And because this is an IRA, you can manage everything on your own. There are no hidden fees, and the only fees you really need to be aware of here are based on the investments you choose. That is now going to lead me into the next discussion on how to truly maximize the opportunity with a Roth IRA. Now, before I discuss particular investment strategies, understand that $7,000 per year is roughly $580 per month, and if you are paid every 2 weeks, that is roughly $290 every paycheck. That would pretty much allow you to hit the contribution limit every year. Not to mention, but because of inflation, the contribution limits also increase over time, where you can see over the past few years they have gone up and they're likely to continue going up in the upcoming years. But whether you can hit the limit or not, at least starting is crucial no matter the amount. And I highly recommend setting up automatic contributions so that every time you get paid, you never forget to invest, because consistency and your savings rate, which is the amount you can save compared to your income every month, are the biggest factors that lead toward a successful retirement. Knowing that, of the investments you could then set up to automatically buy, the best overall ones I'd recommend to consider are index funds, and all that means is that you can get exposed to hundreds to thousands of different companies that track a particular market all within one purchase. And so by purchasing index funds, they're typically very cheap to own, easy to buy, and automate. They offer great diversification, which in turn reduces risk on your hard-earned money. And with the right ones, they have historically done very well for long-term investors. And the goal, I believe, when it comes to investing in the market is to maximize your potential returns while minimizing the risk of losing money. A quote you need to remember here from one of the best investors of all time, Warren Buffett, is when he he said, if you invested in a very low cost index fund where you don't put the money in at one time but average in over 10 years, you'll do better than 90% of people who start investing at the same time. Of all investments there are out there to choose from, the one he recommends most is an S&P 500 index fund, for this case the Vanguard S&P 500 ETF VOO, where you can see it has an expense ratio of 0.03%, which is the total annual cost it takes to own the fund. And even though the past doesn't guarantee the future, a fund like this historically has done very well, and if we look over the past 10 years, the fund has averaged 14.57% per year, which already factors in its super low expense ratio of 0.03%. To understand how good that actually is, let's say you had $100,000 built up in your Roth IRA from 10 years ago, and you continue to invest the max contribution of $7,000 per year. If it were solely in the S&P 500 over the past 10 years, then your portfolio would have grown to nearly $550,000. Of course, the previous contribution limits were different and all things are not constant, but to be more realistic, the US stock market as a whole has averaged around 10% per year, and if we use a realistic example of assuming that you're at the age of 30, just starting your Roth IRA, let's assume you contribute the max contribution of $7,000 per year going forward, which is roughly $580 per month, and if you invested that into a broad US stock market index fund averaging 10% per year for the next 30 years, you could end up with over $1 million. That is completely tax-free and penalty-free, and no doubt would that significantly boost the likelihood of having enough funds to last the rest of your life. I've even discussed in other videos how my favorite strategy with the Roth IRA is to invest for growth now while you're young to build up the account so that later on you can reap a complete tax-free dividend income while still having the account to appreciate in value. If you want to learn more on topics similar to this, I'll have other relevant videos and resources that I created linked in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.